What I hope to do this in the 20 minutes that I have is to give you an introduction to our alternatives business and to share with you some of how we approach alternative assets and in particular the real asset space. And hopefully it's something that you'll find interesting. Now, Momentum has been running alternative investments since 2007. We initially started the business around private equity and hedge fund business in the multi-asset space. We've obviously, over time, we've learned quite a lot of lessons. We've had liability-driven investments in there. We've grown the business. But in essence, the principle of what we do has more or less stayed constant, which is that we're looking for quality assets where we believe we can extract value from. And where we are right now, we still have our hedge fund business. And what we're looking to do in the hedge fund business is that we're looking to deliver on asymmetric payoff profiles where we use a combination of multi-assets, multi-manager strategies, and we have recently introduced a standalone hedge fund equity beta replication strategy. And this has been driven solely by the need to bring costs down in the hedge fund space. So we've obviously listened to investors who've complained quite a lot about how expensive hedge funds have been. So we've tried to create the same type of profile, but at a much more cost-efficient level. And in hedge funds, we manage about 3.6 billion there. And then our private equity business, it's traditional private equity, so we focus there on traditional buyout funds, mid-market funds. And while it's also come from a multi-manager background, we've, in the recent past, been doing a lot of direct investments, or at least we're growing our capability in direct investments. We're doing co-investments, and we're doing a lot of secondary investments. So there's a lot of activity in the private equity space, as you can imagine. And in there, we have just under 4 billion under management. A high yield fund, we introduced this fund about 2 odd years ago. We've got about 2 odd billion in there. And that's in essence just unlisted credit, where we are at the higher end of the risk curve. So we're looking for returns of about CPI plus 6 in there. So it's very much, there's a lot of overlap between that and private equity, but it's very much on the high yield credit theme. And then what I want to talk about, or at least what I want to focus our attention on today, is more on what we're doing within the real asset space. Now, within the alternative space, we've been doing real assets, but obviously in very disjointed initiatives. And last year, just over a year and a half ago, we've decided to actually now focus on real assets as a proposition itself and try and capacitate it so that it can be a standalone on its own. Now, what do we define as real assets, right? So real assets, I mean, our business is really built around 3 principles, and that is that it's an asset with intrinsic cash flows. So we're looking for something that has contracted cash flows. Think of toll roads in this instance. Or an asset where we believe we can build the cash flows, right? So think of an empty space of land, which we can develop and create an asset that generates rental income. So that's the first one. The second is we're looking for assets which play an intrinsic role or a critical role in the economy, right? And then thirdly, and I guess more importantly, I guess for investors, is somewhere where we think we can actually generate value. So we think we can actually extract an extra return because of either expertise or some other speciality that we think we can bring to the asset. Now, to give you a flavor of what's in our portfolios within the real asset space, you all are very familiar with, obviously, we think you're aware of the shortage within the tertiary education space. There's a shortage of accommodation, and it's not only a South African phenomena, it's within the continent and globally, in fact. So with our property development partner, Eris, we've identified properties and have started development in both in Pretoria, Johannesburg, and Cape Town. Actually, the Hatfields properties is close to completion. It should be done within the next few months, ready for the intake next year. The Johannesburg one, which will be attached to Wits in Braamfontein, that development is shortly about to take off, and the Cape Town one later on. And obviously, as you can imagine, the pipeline within that space is it's a very solid pipeline, and we'll be looking to to stretch the developments throughout the country. And then the next one, obviously, I mean, you couldn't be in real space without having some exposure to renewable energies. It's a very topical area, and it's high growth. So we've also got exposure within that space. And this is in both instances where we're looking at big ticket transactions. And for those who are familiar, we're focusing specifically in the earlier stage projects. So these will be window 1 to window 3. And the reason we're focusing on window 1 and window 3 is simply because those projects now have had about 3 years of runtime. So we understand the projects well. They've got track records, so we can build on that. And then thirdly is because the margins in there, or at least the tariffs that were locked in there, are still quite rich tariffs. So it makes sense for us to focus on those, unlike later on projects. But we also we're not only focusing on those big tickets transactions. There's been quite a lot of activity in the mid-sized space on the renewable side. And here we're talking about panels that are putting on shopping malls or standalone generation facilities for a factory or a new manufacturing facility. There's been a lot of activity in there, and we've also started taking bite-sized chunks of those. And then we obviously we've allocated to traditional infrastructure, so that would be toll roads, airports, telecoms, so the traditional space. We certainly have a presence in there. And our focus really, I mean, we're not really restricted in terms, and we're also agnostic about the investment form, right? So whether it's equity or debt or absolute return, in general, we're agnostic to that. However, we do have a preference for equity exposure in these transactions. And the reason for that is that obviously equity returns, the risk profile is slightly different, so you're expecting a better return from those. And also because you can introduce leverage in there, it gives you a lot more opportunities in how you structure it and what you can get out of there. And why do we like real assets? Well, I mean, we heard earlier on about that. We are obviously in a low interest rate, low return environment. So for any investor, you would obviously be concerned about what is the actual real return that you'd be looking for in the long term. And traditional assets are not providing that, so where else do you look? So real assets, or alternative assets, are a good avenue then to look for a real return. Secondly, we're looking for diversification of alpha. And we're also looking for the low correlation that these assets bring. So you effectively, I mean, theoretically, you're looking for that sweet spot where you're generating a higher return but at a lower risk profile. So that's in essence the attraction or the real motivation for going into this. And then you obviously are looking for either an explicit link to inflation, where you'll have, for example, annual resets that are inflation linked, or at worst, then you'll be looking for some implicit inflation built in, whether it's in valuations, annual valuations, or other means of that. And then for most of our clients, such as pension fund, there's obviously a term requirement for long-dated assets, and this fits in perfectly into that space. And then lastly is that we look for assets, as I said initially, that we think we can actually extract some type of value from them. Now, where do we get this return? And I mean, this is a typical discussion where for some people who are not close to the assets and don't understand them well, they look at them as risky assets. But we try to understand these assets well, so that what for others is risk, for us we look at it as an opportunity. And the typical opportunities where we try to extract value are in areas of complexity. The assets are quite complex assets, in the sense that you need a lot more experts in there, whether it's your project finance consultant who will tell you, whether you want a P50 or a P90 cash flows, whether it's your environmental assessment expert who will tell you, if it's built here, you've got a problem with, let's say, a flock of birds that hit a windmill and it now goes out of commission for 60 days or something like that, affects your cash flows, and you never be able to catch up on that. And also, the experience of your building and operating partner, your maintenance contracts, things like that. So there's a lot more complexity in this, opaqueness of cash flows and information and things like that. So we'd expect going into that field that we should be able to realize a complexity premium from these assets. And then secondly is the term issue, and we've talked a bit about that, that you are committing for the longer end. And for that commitment, you'd expect to be compensated for, right? And then because we're dealing in the unlisted space, unlisted and mostly unrated space, you are looking for some kind of credit premium from that. I guess the manager risk, the manager's skill goes hand in hand with the complexity, because you want to appoint somebody who understands the assets, can actually give you good advice on which parts of the capital structure to participate, which manager to appoint, for instance, to operate it for the length of term, and then what happens after that expires. And then lastly is a liquidity premium, right? And where do we see this liquidity premium, or why we would expect a liquidity premium? Now, as some of you would know that, liquidity premium is, or at least in academic circles, it's a bit of a controversial issue, where generally you expect liquidity premium to be available in these things, but the question is, how do you crystallize it? And that's the difficult bit about how do you actually make sure that you capture that liquidity risk. First, it's not constant. It changes based on term, on transaction, on the parties that are involved, what your risk appetite is. But what we do, what we focus on and where we try to distill it is obviously, as I said, in committing for long term. So we expect, obviously, on the liability side, we have long-term liabilities that do require that kind of cash flow. So we have appetite for that for term, but even though we have appetite for it, we still obviously expect some pickup from that. The greater uncertainty of outcome. To give you an example and to come back to the, let's say, the renewable space. So a lot of transactions have been around solar panels, right? So that's I guess, is the most common technology. There's a lot of that. So to a large extent, it's become a lot of plug and play, where there are a lot of advisors in that space, a lot of manufacturers in that space. So if you look at a risk continuum, I guess it's at the lower end of the risk curve. And on the other hand, you'll have something like concentrated solar, where it also uses the sun, it uses panels, but what happens between generation and actually then feeding that power into the grid is a lot more complex and complicated than normal solar panel. So the kind of experience that you need to run the one is very different and very expensive to a large extent than you would than what you would expect from normal solar panels. So there's a lot one would need to understand of that to be able to then to put some type of probability to the cash flow outcome that you'll be looking for in the longer end. And as I mentioned, that from our investors' perspective, we have investors who have appetites at different parts of the term, term profile. So others have good appetite for the 3 to 5 year space. If you think about annuity, normal endowment investors. And then you look at longer-ended investors, such as pension funds, who are playing at the longer end. And from our perspective, we have to make sure that the cash flows that we're able to generate from these assets are able to satisfy those risk requirements for the investors. And that also goes together with the next point about the flexibility, about lockups and creating liquidity. And as you'll know, liquidity is one of those things that, an investor will tell you they want liquidity, but it's not that they actually need the liquidity. It's just the comfort of knowing that they will have liquidity if they need it. So there are ways of obviously structuring it such that we create some liquidity in the instance that it's required, whether it's using other pockets within our portfolios, as using balance sheet to provide that liquidity, where it's not actual liquidity, but at least we do give a promise of some sort. And that's a flexibility that I'm referring to there. And volatility of cash flows, I guess I've spoken to that. However, as you'll understand, this is nothing about this is easy. And one obviously has to be aware of the potential risks, or at least be aware of, the potential pitfalls, so to say, in that. And this is just some of them. which I think would be of interest to you. And the first one is that because of the complexity around these assets, around renewable, around whether it's solar or whether it's gas or any of those energy or power-related transactions, is that fees tend to be high, and there's a reason for that. It's not necessarily always clear why you're paying high. And this is one thing that we focus on whenever we engage new managers, to understand the fee structure, to try and reduce it as much as we can, and to make sure that we're getting value for money for our clients. Right? So think about private equity, for instance. Right? So private equity a few years ago was a very expensive asset class to invest in. Right? So you had a traditional 2 and 20s fee model, which everybody understood that you're paying more than you would pay, for instance, for an equity manager, because of the risks in there and because of the greater level of work that needs to go into a private equity transaction. But we've moved on since then, and now in 2019, you could almost say that private equity has almost become like a traditional asset class. So it's a lot more, we understand it a lot more. There's a lot more skill within our teams around private equity. So in reality, fees should really be much lower than what the traditional model is. And I think within the within the real asset space, that's exactly the way the model is also going to evolve. That because now it's a very specialist area, the fees are understandably still high because of all the experts that are involved and everything that I listed initially. But as time goes on and we understand this asset class better, we expect fees to come lower. And then governance, there's obviously a greater level of oversight that's needed. A lot more people who are involved in the decision making and involved in just signing off on some of these risks. Valuations are also very difficult, and I use difficult obviously cautiously, because difficult in this instance around valuations is about negotiation. It's about understanding what assumptions are being used, what model is being used, just to make sure that it's consistent throughout, and it's also consistent with how you measure in the rest of your portfolio. And also importantly, this is a long play asset class, right? And this is something that when you engage with investors, everybody nods their heads and they understand that. Except 3 years down the line, they call you and they say, "We want liquidity." And you're saying, "Remember I said patience?" So this is one thing that's very important, that this asset class, as with private equity and all the other infrastructure plays, it is really about taking your time to understand that you have to go through the cycles and stay in there, because there's a long-term objective that we're targeting on. And then unlike the traditional space, you don't have the comfort, obviously, of rebalancing or of benchmarking, to traditional benchmarks. So a lot of this is obviously going to be very bespoke around how we measure it, how we benchmark it, and how we balance the portfolio over time. But it's certainly not the same kind of mechanics that you would expect to apply in the traditional market. So as I wrap up, the things that I would like to leave you with, or at least keep in your mind, is that the real asset space is a growing space, right? And there's every reason for greater allocation to this space, for reasons that I've mentioned initially. The Watson Wyatt Pension Asset Study of last year, 2018, they're expecting that by 2025, there'll be about 80 trillion in the real asset space, where now there's about 43 odd billion that's been allocated globally in that space. And they reckon that at the moment, most pension schemes are allocating somewhere between 12 and 15% to the space. But that will certainly grow to about 25% of assets allocated to the real space. So it certainly is there's certainly something going on in here, and it's certainly worth investors having a look, particularly considering that there are no other sources of, or at least they're very limited sources to make up for what you're losing within the equities and bond space. And it also obviously gives you an opportunity to access managers that you ordinarily would not be able to see. So there are a lot of very able managers who are doing very good things, and unless you're in this space, you'll obviously miss access to those. And there really aren't that many alternatives to that. Okay, that's me.